as long as you think about your strategic kind of allocation and say, okay, this is how I want to position myself. And I don't care about the noise of the news and all of this stuff and number and not number and fed and not fed. I think it's the best way, because it's the worst thing in the world that you get taken out of a strategic trade because of some number, which anyway is wrong.
Holy fuck, shit, it's a dinosaur. Jesus Christ, what the fuck? Welcome, ladies and gentlemen, to another issue of the Grey Market Talk with my infamous, famous guest, Nic Themistocles, Portfolio Manager and Chief Investment Officer extraordinaire with assets under management. I love to say that, Nic. 80, 90, a quadrillion, a lot of money.
So much.
A lot, so much money, you wouldn't believe it. And a very humble market maker who was always chased by his risk management team to keep the shop together. So people have asked us, where have you been the last 4 weeks? Mea culpa, it's my fault. As you know, we have a seminar in 2 weeks' time. And I thought, for this purpose, because we hold this seminar in German, I bring a little bit more German content in to give our audience an idea how we explain things, how we approach things. And I said to Nic, you know what? I'm as eager as I am to get the market explained by you. We delay that a little bit and start with a big bang. And hey, what would we have a better situation as we have right now to explain the markets? And let's dive right into it. Obviously, I'm an equity boy. I like equity markets, and equity markets are doing what we didn't like them to do, but what we expected them to do. They kept on bloody rising, for whatever reason. And for whatever reason, that's why I wanted to ask you, Nic, first of all, thank you for being my guest today. I'm getting carried away. I'm so excited that you're back on board again.
It's good to be back.
Yeah, I thought so, because I have a lot of questions, especially bond markets. You have to unpack that for me. So the Fed reduced interest rates, which is usually a good sign for bond markets. What the hell have we seen on the long end in the bond market? Interest rates are going down. So the rate cutting cycle has started. They took 50 pips away. The market should expect more to come. Recession could be there, and bond yields on the long end are doing this. They're going up quite dramatically. We've never seen that in the past before. There was one fantastic chart Steno Larsen posted. I'm putting that in post-production so you can have a look at it. And the question I'm asking myself, can you give me an idea? What is different this time? Why are we seeing this weird reaction on the long end in the US market?
Well, I think whatever you hear, not all of what you hear is actually, in my view, correct, and I think it's a little bit misleading. So, and also there's a lot of criticism about the Fed, where I've seen, look, the yields have gone up, so therefore policy error and all of this stuff. We don't know really what is a good policy and what is bad policy as far as interest rates are concerned. Most likely, the best policy is the one like the Japanese have been running, and I think we talked about this before, where that almost certainly the US almost certainly have to follow the Japanese playbook to keep interest rates down. Why? Because you pay $1 trillion in interest expense. Why?
Remind me again, that's a lot of money. That's more than even you managed in the past, right?
That's a big chunk of change, and that's more than the U.S. defense budget. So when you're running deficits of almost $2 trillion and half of it is interest, you might ask yourself the question: well, so who is getting this interest? So where is the money going? If the whole purpose of running a deficit is that you want to keep the economy going and you want to sort of put money into the right pockets, well, and half of your deficit is going in interest expense, well, then that means your decision is you want half of this extra money, your deficit, to go to rich people, because poor people don't own bonds, at least so as the people I know, they don't own this stuff. So for sure, it's not a sensible policy if you're thinking that that actually running deficits is, is going to somehow put money back into the economy. Well, it does, but it puts it first in sort of the pockets of the rich, and then this whole trickle down theory would work. So that's the first sort of thing to discuss about: is it right policy? Is it wrong policy? And then we have to sort of think about, I'm still getting texts, we still have to think about that shortly before the Fed cut interest rates in September, what was going on was that the 2-year yield was already very, very low, and the market had forecast 10 interest rate cuts.
Yep.
And basically, Fed, you are stupid by not cutting interest rates 10 times between now and December 2025. So that was the kind of the thing. So we know that the reality is that the Fed tends to follow what effectively the market says it should do. So the Fed did follow what the market said it should do. And lo and behold, almost one day later, the market said policy error and sort of removed from 10 rate cuts till December 25 down to 5 rate cuts, almost like in a few days. So was it the market had an error of assessment of what was going on? And let's not forget the market is really quick to jump narratives. So it wasn't so long ago that the market was saying recession is coming sooner than we know, and the Psalm rule and all of this stuff, and the unemployment rate has started to trigger, and it's moved up. It's 4.3. It is really high. Recession is coming. So lo and behold, the Fed, in their justification for cutting interest rates by 50 basis points, they kind of say, well, we think inflation is on the right, path. And by the way, we're a bit worried about the other side of the mandate, which is the job situation. So we're going to kind of make sure that we start with 50. So they did start with 50, and then the market just said, "Nah, that's totally wrong. So does anyone really know what they're doing? No." So we're trying to sort of say what has really happened with the rate move in the 10-year. We must also understand that the Fed doesn't influence the 10-year. So all of this, you're losing control of the 10-year. Really, I'm not sure. Partly it's what they do influences the 10-year, but the 10-year is influenced by other factors. So if we break down where the yield is today, where is the yield today on the 10-year? It is 4.25. So 4.25%. We got down to 3.5. By the way, the forecast that when we were showing charts not a long time ago, the target I gave was 3.5% for the 10-year. And then I expected a 3.5% to 4% range. I actually didn't expect suddenly a blowout. We got past that 4%. We always exceed targets. We're now at 4.25. What is that 4.25 made of? So that rise in interest rate from 3.5% or 360 really, wherever it was, to 4.25. Interest rates are composed of two factors. One is the inflation expectations, and the other one is real yields. Yeah. So inflation expectations went from 2%, which was the lowest that they have been for the last 2 years. So it got to the low end of that range, and the high end of that range is 2.5. Where are we now in the expectations? 2.25. Is this about inflation? Is it policy error? You would say, well, then your expectation of interest rates should be suddenly breaking out of this range of 2 to 2.5, and maybe we're at 260 now or 270. You've cocked it up, guys.
But Nick, I never liked this inflation expectation chart anyway, because we talked about that on the channel as well. When you look into the past, it always said in 5 years' time, we expect 5 years inflation to be 2%. And whether interest rates are at 0 or at 6, it always had somehow this level between 2.5. How reliable is something like that? What I see at the moment,
long-term inflation expectations.
Correct me on that, because if I bring it really back down to basics for a stupid equity market maker, to say, what does a 10-year bond actually tell me? That people say, if the yields at the 10 years are rising quite dramatically after a rate cut, that's the implication for me to say that bondholders who are buying now 10-year stuff will be the back holders eventually, because the market expects inflation will be higher. real rates will be going down to zero or negative even again, and therefore you're an idiot if you spend your money on a 10-year bond. And that's what we're seeing in yields.
And I would then say to you that all sounds totally plausible. However, there is an instrument in the market where you can measure all of this stuff, and that is the tips. So the tips rate. So the real yield is actually what went higher, not the inflation expectation. The inflation expectation moved by 25 base points to the middle of the range. Don't care, right? So I don't care about that, but I do care about the fact that the real rate has gone up. And we know in an environment where you're a sovereign, you've got a very high debt situation, and in theory has it, ultimately you want to inflate away your debt.
Yeah.
You want to, put in financial repression. Ultimately, you want the interest rate to be lower than the inflation rate. You want to stimulate growth, so your tax receipts start to increase because you're stimulating growth, and so on and so forth. That's ultimately what you want. And what we actually saw was, in this recent move, a rise in real rates, which is sort of more leaning towards, actually, the thought process of 10 rate cuts day before, to put pressure on the Fed, 10 rate cuts, they do too, and they say, we promise we'll do some more. I was never in the 10 rate cut camp. I was always in the camp of they'll probably do 3 by the end of the year. So they did 2 in one go, and they'll people are still looking at 25 and 25 and next week and or in November and in December, but I still sort of consider one more is probably enough. But you had that push to the Fed, forcing the Fed by the market, in my view, and the market does influence the Fed, to actually cut, aggressively. And cut aggressively because every single Wall Street and analyst and YouTuber out there is saying recessions. You guys have held on for too long. They probably have. They shouldn't have gone so high in the first place. But the Fed felt I've got to do something. But then, right, straight after the rate cut, I think we got an employment number, didn't we, or something like that? We got that famous employment number that only a week before was revised down, so the employment down by 1 million or 800,000, US citizens. So the number that is totally irrelevant and untrustworthy, one day after the Fed cut their rates, suddenly was enough for the market to say policy error or full growth now, the economy is booming. So what does that show you?
It shows me that what I saw, sorry to interrupt you there, what we've seen now with the ECB, they went in for the rate cut. They set inflation expectation as at 1.8, and they just revised it after the rate cut to, German inflation is at 2.3 suddenly again. Yeah. So brings me to almost a philosophical question in this whole scenario, Nick. You and I are old school. Well, I'm more old school because I've learned it how to interpret numbers when the numbers are real. Now I seem to be living in the world where you can't give a flying F about what actually the official numbers are. Seen it with what was consumer confidence, bumper number 108, expected 99, something like that. Whomever you speak to in the United States on the ground, that's not the truth. There is no consumer confidence at the moment. So how do I trade a market when the only information I have is actually the price action I see on the screen?
You've just answered your question. If the only information you have on your screen is the price action, you trade the price action. And that for me is fundamental. And this is, if you listen back, if you think about what, the things that I've been saying over the last couple of years, economic data is all very interesting. However, you cannot trade a market based on economic data. If you were looking at leading indicators in 2022, you'd still be short. How can you do this? So what's actually happening is that I think the market is becoming more nervous. is because certainly, you could argue that election is part of that nervousness. The market is nervous because there's more sort of uses of the term World War III in newspapers, and frankly, that's a good reason to be nervous. There is tension out there. And so when you see a market behave like headless chickens, running from one number, in the old days, there was a comedy series in the UK called The Benny Hill Show, where people were running in one direction, running in the other direction. And that's exactly, the market is The Benny Hill Show right now. And it has no clue in my mind about what to do. And for those people who are pulled from one side because of some number and pushed to the other side because of some number, this is the wrong way to behave. And calmness, and I think the last thing I said to you in one of your virtual trading rooms was, I've closed sort of most of my tactical trades and I leave the strategic trades. And why? Because tactical means you will see for sure your position go offside, and you'll be saying, I have to sort of got stop loss on this, I've got to sort of close this thing or take profits, and you're very active on it. And I think the strategic trades are still the right ones. And we've been speaking about the strategic trades for the last year or so since we began this thing, where we say, it's gold, it's Bitcoin, it's some stocks, and it is, and now it's a question of region or not region, sectors or not sectors. Fine tune this thing, but what is it not? We've always spoke about financial repression, so it is not long-term bonds. So as long as you think about your strategic kind of allocation and say, okay, this is how I want to position myself, and I don't care about the noise of the news and all of this stuff and number and not number and fed and not fed. I think it's the best way, because it's the worst thing in the world that you get taken out of a strategic trade because of some number which anyway is wrong, by some people who have hired thousands of PhDs or hundreds of PhDs, and yet they still don't seem to understand how the economy works. So for now, in a very confused market situation, I sort of stick to more the strategic thought process, because the rest of it will be noisy. And if it's noisy, you need to be in front of a screen, you need to be able to trade it, and that's fine if you are, and it's great if you can. But otherwise, I would just say the narrative this week won't necessarily be the same as the narrative next week. Certainly won't be. There'll be a new president, so there'll be another narrative that we'll all get hold of. And that kind of explains what's going on with bonds. 10 rate cuts, 5 rate cuts within a week. I've never seen anything like that in my life. Based on a number that nobody trusts in the first place. That's just nervous trading, or it is people who are sort of taking advantage of 3.5%, which is way too low for the 10-year for a long-term position. Why is that too low? Well, because even if you think that inflation does get to 2%, and even if you think maybe it goes a tick below that, at the end of the day, then you have to sort of think, and you have to believe that there is going to be a recession. And when the government is still insistent on printing large deficits between now and as far as the eye can see, the economy ain't going to go into recession, or it's going to be a struggle for the economy to actually get into recession. They have to do a really bad job for that. Of course, we'll all look at when Musk is part of the the team, and he said he's going to cut the spending of the US by $2 trillion. Where? Great if you can. I mean, the man is a magician. He can possibly sort of influence that. That might well influence the deficit. That means less money going into the system. That means we have to think about different problems going.
And let's go on the top level, because if I break down the US budget, 35 trillion
Yeah.
debt. Yeah, some about today. In a month's time, we have more. So, what are the three big cost blocks the United States have? Military, Social Security, and interest rates, interest
Yeah.
payments.
Yeah.
So, because the ordinary, what you hear in the market now is being spoken often, but what could happen? Will they reduce military spending? No, they can't. Not in this world we're living in. Social Security, no way they would do it, because if you would start cutting one, two, or both, you would end up in a recession. You end up with a higher budget deficit. Okay, fine. So what can they do? They can lower interest rates and say, stuff real inflation. Yeah, we're just screwing everybody over. We inflate our way out of that. But that's always and that's where I want to break in and say, people have forgotten that you actually can fight inflation by producing more shit. And
Yeah.
nobody has that on the
Absolutely.
radar anymore.
Right.
It's
But
just that that's the only option we have. We can lower interest rates and just print our way out of that and live with the inflation. Bad for you, bondholder. Thanks for the donation. That's a line I heard earlier. But if you would get the right political system where they say, you know what, I like Trump's idea, completely abolish the IRS, just have tariffs. That used to be the US system before they started introducing income taxes.
so, it's something relatively new for, people of this generation to kind of
Oh,
understand.
yes.
But also it's going to be a very difficult thing overnight to implement. So it will also take time. And of course, the people who are going to be suffering tariffs, they're not going to be sleeping. Maybe they devalue their currency, maybe they don't. What does this truly mean? And I think, there's a lot of thought that needs to be put into that going forward. But it still doesn't change the idea that the first thing that you can imagine that they want to do, and when you talk about having control of the 10-year or not having control of the 10-year, you can't have control of the 10-year by adjusting the overnight rate. I mean, that's just, you cannot do that. Part of so I run a model that says the theoretical yield on the 10-year is 4.25. Oh, that's where we are. And part of that model uses the overnight rate, but the rest of it is growth, it's inflation, and so on. And that's what we have to think about. So how do they influence the 10-year? So, I mean, real interest rates, what else influences real interest rates? Why are real interest rates going up? So, we have to think about, is there extra supply? Oh, this happens to be, yesterday they announced the quarterly refunding. They announced for this quarter, they're going to need 560 odd billion. And in the first quarter of next year, 800 odd billion. The odd billion is going to be a large number as well. But that's a lot of issuance. Now, what they used to do when they were controlling yield curve control, what they used to do was they basically issued a lot of T-bills. So the T-bills, they issued a lot of T-bills, not a lot of 10 years. So they managed to sort of maneuver the yield curve a little bit flatter than where it was, while everyone was then thinking, oh, flat yield curve, recession. I know
Yeah.
look in my book, it says flat yield curve, recession. Right. Okay, let's sell the market. So they're all wrong, because that yield curve is manipulated, and it was manipulated through supply. And the issuance of extra bills was being absorbed by the reverse repo account. The reverse repo account is practically zero. It's 200 billion, sorry. 200 billion. Sooner or later, that's basically gone out of the 500. So what you're likely to see now over the next 6 months is a far greater proportion of issuance of 10 years, right? I mean, more than possibly that they've done before, because it's not going to get eaten up by the reverse repo. So they have to go and find another buyer for this thing. And that's the kind of the fear at the end of the day, that there is more supply coming in at the time where the Fed have not yet gone full QE again. So they're still in that kind of QT mode, maybe a bit softer, but they're still in this QT frame of mind. And that just means the more supply you get in the 10-year, the higher the yields, the higher the volatility in the 10-year. When you get high volatility in bonds, then you get less liquidity because there's reduced balance sheet capacity. This collateral is obviously sort of worth less than it would be if it was under a low volatility environment. Low liquidity, theoretically should spill over into risk markets. It hasn't yet. I would say if the MOVE index, which is the volatility of bonds, goes above 150, you may well get that. But I think all we're seeing is this shift in attention into an additional supply, because the plumbing, which I don't think people are still talking about, the plumbing basically says, okay, probably there's going to be a little bit more being issued in the long end of the market than there probably was in the old days when Janet Yellen was manipulating the 10-year. And of course, she was manipulating it when, right up until the election. Oh, funny that, right? Which we know that was sort of part of the game. And you can't do it anymore. You've run out of sort of manipulation juice. So
Well, you mentioned that already a year ago, and I remember that distinctly because you said the only option then is when it gets political. That yes, they issue more 10 years, but somebody has to buy them. Otherwise, yields go through the roof. And you said, well, they will force people. Yes. Pension funds, everybody in the US, you have to hold that crap, whether you want it or not. That's the new law. Follow it.
Indeed. And of course, maybe I was far a bit, ahead of my time, as it were, but that is still valid. It's not something you can trade the next day that I say something, but it is still part of this strategic thinking to say, okay, what do we know is going on? We know what is going on. And, I spoke about part of this at the time when we talked about Japan, the repatriation. Every country is, you start to go into a tariff world, every country is looking after itself. It's not interested in this sort of global arms around each other anymore, global trade and stuff like this. Now everybody looks after themselves. And when everyone looks after themselves, how do the Brits deal with it? They've got their the Chancellor's doing her talk today. So,
I've watched parts of it. It's horrible.
Right, I haven't yet. I wanted to see what the bond market does. But the how do they manage it when their pension funds are going to buy US government bonds or French government bonds? French need a lot of money, so German government bonds or Japanese government bonds or something else. How do the Brits sort of how does the Chancellor respond when the pension funds are sort of putting money elsewhere, not in the UK economy? So what they did was they forced the pension funds in the UK to invest another, I think it was 50 billion, like the largest, whatever it was, pension funds, to invest another 50 billion. That's still a small number, but once you start this thing, that number will sort of multiply itself. To invest an additional 50 billion between now and 2030, plus they have to make full disclosure about how much they're investing in the UK and how much they're investing elsewhere. And, I said the last time we talked about this ages ago, was that, the moment politicians see transparency, they're going to say, oh, do you realize that this pension fund has invested zero in the UK economy? Well, we're not going to have that. We should do something about it. We should legislate. They should. And the Brits do that. The Japanese will do that. The Americans will do that, and so on and so forth, up to the point where, they'll allow the diversification, but they will say there's going to be a minimum. And one country does it, they'll all do it. It will be a different game to the game that you've played before. And that's important to try and think about, where has money flown in the last years since 2000, since the global financial crisis. It's only gone one way. It's gone into America. The moment even a bit of it trickles out of this country, we've already seen that central banks don't buy US government bonds anymore, at least the traditional ones, the Japan, Chinese. At the moment, the Brits are, the Europeans are. But when they're not buying this stuff, what are the things that they have been buying? Of course, they've been buying Apple. They've been buying Nvidia, as well as government bonds. And, this kind of impact over, don't go out there and sell Apple and Nvidia tomorrow morning, for God's sakes. But you know what I mean, that this flow of money will find its way back into home countries by virtue of the fact that the governments will force it. And why would they force it? Because the central banks, the Japanese can't keep the yen up by jacking the interest rates up. You can't do that because we just
Yeah.
explained that interest rates need to go down to keep the debt levels down. So how do you keep the currency up and stop collapsing when you've got low interest rates? Because you can't jack them up because, otherwise things will start to break, right? So you say, well, actually, we've exported a lot of money in the last years or so since since the Japanese, since the Nikkei collapsed. Maybe we should get some of it back. And I think, new politicians, new policies, and I think that's the way of the world. When does that happen? Well, you're going to start to see here and there bits and bobs.
Do the other markets have sniffed that already out? Because I know we talked about that a long while ago as well, where I said the only point is which justifies rock high valuations of equity markets is if you look at the Weimar Republic or at Venezuela, yeah, where at the end of the day you're being screwed over. So the scenario we've developed now is United States will have to lower interest rates, otherwise the deficit will kill them. No chance. And they can't reduce military spending, they can't reduce social security spending. What they can do is they pump down interest rates down. Then somebody has to buy that stuff. You lock them in politically. You say, okay, fine. You have to hold 20, 30, 40, 50% of your pension funds in US treasuries. Then you spring capital controls on the guys. Then is the magical question, why on earth is the dollar strong at the moment? Because if you want to buy gold, it's still traded in US dollars. If you want to buy US equities, real assets, it's still traded in US dollars. So you have a strong US dollar. You have an equity market who seems to be strangely resilient. Not saying that I'm now getting bullish on equity markets, the opposite, but it's an explanation why we've seen this bloody move, because the market sniffed it out earlier. You're not going to be happy with bonds in the future. So what are you going to have? Stuff that actually, if real interest rates are below zero, everything becomes a very attractive investment, which has at least zero interest rates in there. Is that the explanation for what we're seeing at the moment, Nick?
I would not get too excited about what we're seeing today, about sort of what we see in the future. What we have been seeing is a gradual trend of people loading up on equities in the US, especially in technology. So there are reasons for all of this. And, the reason for the dollar going up is not because they are buying, suddenly there is a sudden, let's just say, a carry trade again. Although that may well be happening, because if you look from the date of the Fed rate cut to today, or at least last week when I pulled its chart up, the yen has basically collapsed, and the dollar has gone up, and everything in between that's part of the DXY, the dollar index, hasn't really moved. All right, so you could argue that immediately after the rate cut, perhaps there was some carry trades to be put on. Maybe people have done that. Yeah, I mean, it's quite possible. So don't get too. I don't get too caught up in sort of this is going on, therefore it will last forever. I try to look at sort of the longer term picture, but this is just a reversal of what we saw before, where people were frightened of selling the yen, but now they're not so frightened about selling the yen because, effectively the government have said, we're not going to raise rates for different reasons. The Fed sort of suddenly these rate cuts have been taken off the table. So the pure interest rate differential is in favor of the dollar and is absolutely against, the yen. So that was an obvious trade you would put on, at the time, and where you take it off is a different matter.
So let's move a little bit over now. I'm also going to put that into the screen. On Monday, on my virtual trading floor, I got hold of a slide which compared actually the Magnificent Seven of 2000 with the Magnificent Seven of today. And it went into, obviously, the classical earnings per share, part of percentage of the overall market, and profit margins. And I was really surprised because I thought what we see at the moment in the Magnificent Seven is really textbook 2000. It's not. The Magnificent Seven today are still not just a little, but quite substantially cheaper than the Magnificent Seven in the 2000s were.
Yeah.
Gave me a head scratcher.
Well, I mean, obviously, it's all relative, and it all depends on your anchor point. So, if you were looking at this market from 2022, you'd be saying, "Oh my God, this is super duper expensive." It is, right? And comparing P ratios to the crazy times of the 2000s and the dot-com boom, you're right in some respects. Doesn't necessarily mean that the Magnificent Seven today are cheap just because they're not as stupid as they were before. I mean, we have right now high expectations on earnings. I mean, in the last 3 years, in the last 2 years, and then if you look at 2 years hence, so 2025, 2026, you are still expecting, or the analysts, I should say, are still expecting 315 or thereabouts earnings in 2026 for the S&P, right? So if you're expecting 315 earnings coming out of the 500 names in the S&P, and the S&P is trading on a forward multiple of, say, 21, you multiply the two together, you're now at 6,500. So you are still implying that the market should still go up until you've actually sort of changed your mind. You say, well, you know what, these earnings, they're coming in. The CEOs are saying, actually, you know what, it's not so good as we had thought. But it's actually, so let's move on. So firstly, the market is very optimistic on earnings. They may be right, they may be wrong. We don't know. These are forecasts. And we know with forecasts, what actually happens is you never really get there, but you just sort of postpone them a year. Yeah. You see a lot of that. So they're forecasting big earnings. The multiples have started to edge higher. So in the last 2 years, the multiples have started to move up because you can't sort of put the earnings up. Flow comes into the market, right? So what has to move? Right. I can't move the earnings anymore to justify it. Got to move, the price has to move. Is the release valve. And then you say, well, actually, got even more money coming into the market. How can I justify that? Well, I know, I've got a good idea. Let's just forecast another 1% on net margins for the S&P. So you've seen margins actually being forecasted sort of quite sharply higher. So margins are going up, PEs are going up, earnings are going up. Well, if that all happens, 6,500. There you go. It's pretty simple. If you start, and that's why this earnings periods are all very important, is so analyst expectations versus what these guys say on these calls, and they're not sort of, but boring, got another earnings round. It's actually quite a useful kind of thing if you're in the market, because those earnings, when you add them all up together, if they don't reach the kind of forecasts that you expect, then obviously that's going to take a hit. In this quarter, for example, the earnings growth is expected for the, I think FactSet, they do a very good every Friday. You should read this. Every Friday they do a summary. A couple of weeks ago they had one, and basically it's saying that the forecast for the Magnificent Seven was 18% growth in this quarter. For the not magnificent 493 S&P 500 names, earnings growth 0. So, but net 4.3% growth. It's actually quite low because, on a year-on-year basis, they've been forecasting a lot higher. But in order to keep the market up, lo and behold, the forecast for the next quarter, Q4, are back to sort of 15% or something very high. But it's important to follow this stuff because that's the only tangible that the people who are trading this market are working on. And what is it that suddenly you're going to say, but if that's how it works, it's just a little bit of maths, you get your calculator out, you don't need many buttons, and you say, okay, 6.5, all right, 1,000 or 6,000, whatever you come up with. Is it sort of as simple as that? No, because that's where you look at the other side and you say, is there liquidity in the system to enable you to go and buy these stocks? And when liquidity starts to get tight, that's when the multiples start to go down. Yep. And that's when you start to get a repricing effect on stocks. But whilst all of these things are visible, let's just say, those are things that interest me. Somebody giving me an unemployment number or the claims number for the Thursday and the JOLTS number and all of this stuff, they're great for the YouTubers, who sell their videos and subscriptions and stuff because they have to supply content. But in terms of, for an investment sort of thought process, they are confusing.
Because confusing. You said it earlier, on the strategic side, not on the tactical level. And when I dive into that again, so we've just established bond market. Okay, fine. They'll keep on printing money. They will take the interest rates down. Real interest rates, real yields will be negative eventually. They have no choice. It's going to happen. Then you have the corporations, which in itself, compared to the bubble, yes, never mind, in 2000, are relatively cheap in there. If the operating margins stay stable, and there is no competition in this market we have at the moment from the bond side of the market, and we are not getting a recession or anything in. Does that mean really equities to the moon? Because that would be the final sign I'm waiting for now. We are approaching 6,000. We're going above 6,000, 6,500, and then you usually have the guys coming out, or we could be at 8,000 in 12 months' time.
In theory, the number you just came up with of 8,000 effectively is just kind of the straight line forecast, and that means that you're not expecting any kind of economic cycle. And we know that the economy and the business operates on a cycle, and there are different cycles operating at different times, but generally the business cycle is 5 to 6 years. I mean, Michael Howard talks about that a lot as well, where he says, okay, well, it's 5 to 6 years. We're probably in the second year or in the third year of it, so kind of we're peaking, and that's about right, actually. And that sort of suggests, therefore, that whilst the numbers, whilst you can continue to forecast high earnings and high margins, and liquidity is still there, so you're okay, sort of charging 21 PE as opposed to 20 PE, and therefore you come up with saying, okay, it's going to go to 6.5, or it's going to go to, well, wait. Because when the cycle starts to turn, well, then something else needs to happen in order to sort of buy, or there has to be another reason to buy equities. And usually what happens at the time then, when there's low liquidity, is you say, okay, well, I take the PE number down a notch or two, 17, whatever, 16, and suddenly we're back to 4.8 or there at 4,500 on the S&P instead of the forecasted straight line equivalent to 8,000. So the cycle becomes very important, and that's why watching the earnings move and to see how these things are adjusting. Obviously, earnings are historical, but you listen to I read the reports, obviously, how the CEOs are thinking about the next quarter. That becomes a very important factor. And, I try to sort of avoid, as I say, a lot of things that are a lot of noise. Most important thing you care about is, do these people make any money, and how much money do they make? And if they do, you're okay. You're okay as long as there's liquidity. And, as I say, liquidity is an important thing. You just touched on one point about, the value of bonds versus the value of equities. Again, it's a point I think I made in the very first few videos where I said, look, the earnings net in stocks is going to be relatively low for the next 10 years. But for the next 3 years, you'll probably make a lot of money in stocks if you're an investor. So this is the kind of thing where we are PVing all of the return expectations now into the price of the stock. And then, we value, NVIDIA, maybe a great company, maybe it still goes to 200. I don't know. It's not I'm not the analyst for that, but, we're PVing all of this thing. And then there's no shock in our forecast. There's no, what happens when, we get a bad quarter, or we just can't get the chips anymore, or, Taiwan Semi has got to sort of, they got a strike, something.
Yeah, it's especially, that was also one of the points that came up on Monday in our internal discussions. You actually only have NVIDIA, which is doing fantastic, and pretty much the whole semiconductor market is not doing anything. You have a big divergence going on there.
Absolutely.
We were looking at that. I think you started with Taiwan Semiconductors when you said at the time, NVIDIA is showing bumper numbers, but they're not producing this stuff. It's being produced in Taiwan. Where are their numbers?
Yeah, the number they recently came out with, I can't remember the numbers, 39 billion for the quarter or something, which is extremely high. So, the market seemed to be quite happy with it. But I think, like everything else, as we try to dissect this whole AI revolution, is to say, it's really fascinating. One thing I said when we first talked about it was, I did AI at university, and I was at university in 79 to 82. That's how old I am. We've been doing this for a while. So now these new chips, and it's all very interesting. And okay, let's go and see products come out that make companies far more efficient. I mean, ChatGPT is already, you don't need a NVIDIA chip. Just use ChatGPT. You're probably super efficient already. I mean, it's made most people efficient. But other than ChatGPT and these large language models, what, are we going to have robots? Are they going to sort of replace workers? We already do have robots. Robots are in the factories already. Go around some of these car companies, there's like 10 people there. It's not sort of the thousands of people in the work, like they used to be. So where is the revolution going to come from? And if we don't see the benefit, well, then, the value of NVIDIA is sort of, it's managed to sell a lot of stuff to a lot of people, but a lot of people haven't managed to make enough money out of it. So the Metas of this world and all of these people who have, gone crazy because they want to be part of that revolution. But if they can't make money out of it, they're just going to sell me another advert.
At the moment, they're giving it away from free. I'm using Perplexity. It's like ChatGPT, but it also gives you the source material, which is very helpful. Yeah, so you have the academic papers and stuff behind it if you're researching a topic. Fantastic. But I see I'm not naming a younger member in my household is using ChatGPT. If she's writing an official letter, yeah, because she wants to correct it. It's not her first language into the proper shape. Huh? And then she gets an official letter back where you actually know the other side did exactly the same. And I thought to myself, why do you guys actually talk to each other? Let just the GPTs chat with each other and sort it out and eventually tell you show up at this day, at this time to do that. And it's a weird scenario we have there. But going back to the equity markets now, I'm still stuck in this line. We've eliminated bonds as the investment for the next 10 years. Yeah, it seems to be sucky.
Maybe, but even just.
But we would need different politicians, Nick.
Yeah, okay, but if you're getting paid 4 or 5% on something, and the equities are also not delivering you enough, because why the equities not delivering you enough? Because all of the pension funds are up to the gunnels in buying treasury bonds or gilts or French bonds, buying all of this stuff, and they say, well, I haven't got any room for more equity, so suddenly, the equity is out in the street. And so you're not making money on equities either, other than, whatever yield you get from these guys, which is sort of 1.4%, good luck. Tell me, potentially.
Well, my thought process would be the following. Yeah, I have a buck of money here and I want to do something with it. And I have negative real interest rates. Because that's what the politicians want. They want to inflate their way out of that debt. So where I'm putting my money in bonds, where I know the purchasing power will be less and will deteriorate it, or I buy myself equity companies which are able to hand on the real inflation to the consumer. Yeah, so I have a way out there. I'm not getting anything in real interest from my bond portfolio, but at least I can hand it to the guys who automatically increase the prices for their product. So I'm being compensated for the inflation in that corporation. Or the other alternative, we're going into gold. And we've seen both of these markets actually doing exactly what would make sense when we have this scenario coming in. The question is, and here I'm again with George Soros and Druckenmiller, who said, when I see the beginning of a bubble, I go in and buy everything I can possibly get my hands on, because bubbles tend to get bigger. The question I have for you, and I know it's difficult to answer, surely we are already further than the beginning of the bubble, but is that at the moment a bubble which can take us far beyond the levels we are now before the eventual, at least temporary break has to happen? Or because we were cautious in a way where we could still make money. The straddle we set up when we went on the old, trying to break the new or the old all-time high, making money nicely, sleep well. I was wrong with my negative outlook, but I'm making money now on the upside. So I'd like to keep that on. If you're telling me there is a good chance that we really see these elevated levels of, we said 6, 5, 7, 8.
So when I was buying gold, or when I was buying Bitcoin or silver or gold miners or whatever, all of this stuff was at the time where the market was focused on something totally different. Now every other video is, oh, you got to buy gold or you got to buy Bitcoin, and financial repression, and suddenly everyone learns about all of this stuff. So they all jump on the game. The point of recognition in Elliott Wave is like the middle of the, when you see a lot of identification with the story, that sort of tends to be like the middle of the path that you're on. So we may well be in the middle of the path, that we're ultimately going to get to, but it's a lot easier to handle noise in your sort of in the bubble price thing when you have cushion. In other words, you bought at a very low level.
Yeah.
For the people who are just coming in there saying, should I buy gold? What do you say to somebody when, you're at 2,800 and you might even see 3,000 before this thing sort of takes a little bit of a correction? But you're buying just this momentum thing. And I think that's a very, not so smart thing to think about, because you have this point where you have this surprising disappointment. Remember this bit where you say, well, hang on a minute, I mean, the bubble's supposed to be here, supposed to just buy this stuff. And what does that remind you of? You get a lot of it, you had a lot of it in the crypto world. Bitcoin to the moon, 20 grand, ship it in. It went from 20 grand to 3 grand before it went up again. So, there sometimes you have to think about rebalancing your even a strategic position, because let's just say you started with a 100,000 investment portfolio, and you started to have 20,000, which was already a large portion, into crypto and gold for whatever reason. Well, I mean, given what's happened to the markets, that percentage has probably increased quite substantially in your portfolio. So shaving a little bit off on the profit and rebalancing is probably not a dumb thing at the time where people are coming in saying, oh, I've heard there's this gold thing, should I be buying it? And you're thinking, well, maybe I should be sort of just lightening up a little bit here, because just the price appreciation has increased my weight and therefore made it much more risky theoretically.
But where you're putting it, bills and chill, yeah. Short term?
Yeah, because I'm quite happy to see rates go up, and I'm quite happy to see the UK gilts get absolutely hosed, because I just sold a house, and therefore that's not a bad yield for a couple of years, is it? 4 point whatever it is. What yield did we get on the rent? A lot lower than that, I guarantee you. And then what did you have to do? You had to sort of call the plumber, get all of this stuff, worry about this, that, and the other. It's going, sometimes simplicity is not a bad thing, but you've still got a core position, at least a core position in your strategic, ideas. And that, we told everyone beforehand, don't say, still people are just waking up to, less thought process about what a portfolio really needs to look like in a world of financial repression, in a world where almost certainly the central banks will have to do something in order to avoid a financial collapse. Let's just face it. I mean, the alternative is war. So that's why, we hope that the central banks print their way out of it. We hope that they force the pension funds, because we do not want the other consequences of a financial collapse. Sorry.
It brings me neatly to my last point. The big term, anti-fragile assets. Obviously, we already are invested for a longer time, you and I, and well, people who have been gold bugs for a while. It's one of the classic anti-fragile assets. Bonds has disappeared from that rooster. Yeah, in the good old days,
Short-dated bonds, I think, are still okay. Yeah, short-dated.
yeah, but long dated. Yeah, in everybody,
Yeah, I mean,
the younger guys can look 87. What happened? The stock market crashed 20% on one day. The bond boys were swimming in money. Yeah, everybody went into long U.S. Bonds. That was the saving point. Then we've seen that 2020, everything fell like a stone. Or the great financial crisis, 2008, 2009, everything fell like a stone. The only thing that went up was volatility. And now, and that bugs me a little bit about the scenario we just painted to say, yeah, fine, maybe equities can still have this run. I did this study a couple of years ago. I published it at Bilal's at Macro Hive, and I simply looked into how did a portfolio with 1 year maturity. So the idea was simply, I want to have a lot of data points. And I said, every day, a 1 year portfolio, the VIX was below 15, between 15 and 25, or above 20 was the point, above 30. What was the performance? And on average, if you are now turning into this regime where we have the VIX above 20, it's not a good time to be invested. However, now we have the election. Right? And until the election and the eventual recount and the revolution on the street and, secession is over, we're probably staying high on this side. I've never seen an election cycle in the US which was so aggressive as we have it now. It's sheer unbelievable, yeah? 2 assassination attempts on one of the candidates. If we are in this market, and that's why I'm squaring the circle to earlier, I can't trust the data anymore. I trust the price action, and I trust the analysis I've done myself in the past, and that told me I don't want to be necessarily overexposed in equities when equity volatility is above the level of 20. It's simply not prudent to do that. And even Goldman came out last week, I think, and said, the expected returns for the next 10 years in equity markets are actually, as you said a minute ago, quite meager.
We send that data to our clients every quarter about the 10-year returns.
Yeah.
We send that as a kind of a sort of touch with reality thing, because it is important. When you did your study, and by the way, I remember your study. I used it a few times with clients because fantastic work.
Yeah.
Were you using the index or the VIX index or the futures?
VIX index. I went through the pure VIX index. We all know, yes, it is a bit difficult because the calculation is different than just the at-the-money volatility, but as a proxy over long term, it's reliable. Yes, you have the spikes we'd seen on the 5th of August, where the VIX was trading at 65 and the futures were trading at 32. Yeah. That didn't make sense there because the skew, which is calculated in the VIX index, there were suddenly no market prices for the puts at this point in time when the carry trade collapsed. So that gave it a little bit of a twist. But usually the VIX future and the VIX are in tandem somewhere. So that's why I relied on the data I had out there. And over all the data sets I had, I think it was over 7,000 portfolios. It made sense to crunch these numbers and go into at least the cautious mode. We might drop below the 20 again, and that is the ideal scenario now. Nothing happens on the inflation front. They can reduce interest rates again. Corporate earnings and profit margins remain stable, and volatility goes back down to 15 or something. Yeah, then you have your case. Then I would be, even if I hate to carry over expensive stocks under my arms, I would keep them until this scenario changes.
You're doing it much more sensibly than me in that thought process, because at the moment, as you say, where is the VIX right now? It's actually just ticked under 20, and the futures. So past the election, so we know the first contract is going to be the election.
Yeah.
Little wobble, but the contract after that is also 18. So it's not there's no sign there of concern. Nevertheless, a portfolio of risky assets with protection is still not a bad portfolio. And I think it was Talib and Spitznagel in the States, they run a portfolio which is, I think, 95% equity and 5% permanent hedge.
Yeah.
And that seems to have been a very smart way to run portfolios in the future, and maybe it is now. And I think I said it also at your last virtual trading meeting that I was taking a punt on a long VIX trade as well, small size, because I still fancy what else can you do in terms of if something were to go wrong. Those are the points that you're likely to see.
We made recently good money picking up pennies in front of a steamroller by selling puts on the VIX, because I thought, no, volatility is simply, nobody wants to provide that in this scenario at the market. And we've seen that. So we were selling this 16, 15, 18, depending on the markets, and they all came in lowly. Yeah. But now eventually you have to look forward and say, okay, what's happening after the election? And we went through all these scenarios and said, okay, a clear win for the Democrats, good for the market, because Republicans will not go out on the street and riot. A clear win for Trump, I think, also good for the market. If you can say what the betting markets are indicating us, that he will have a huge landslide, that's bizarre. You have all the official polls coming out 50-50. It could cost a coin. And then you go on the betting markets and see, oh, he's leading with 63%.
With the betting markets, I understand that they are also somewhat manipulated.
Well, there is a bias in there. I was thinking about that because I thought 50-50 in the polls and 63% in the betting markets. How is that possible? And I thought, well, think about it. Who do you find in the betting markets? Liberals? No, liberals never risk their own money. So you find punters, capitalists in the betting markets. They're far closer to the Republicans than they are to the Democrats. So the betting markets are necessarily skewed to the upside for Trump because you find more conservatives and libertarians in the betting markets. I don't know by which percentage you can take care of that. What's the error rate in there? Maybe it's exactly this 13%. And if you would deduct for that, you're again at the 50-50. But what the market needs is clarity. And I think this election will not deliver that. We might end up counting like Gore-Bush still in January when it comes to, down to Pennsylvania or one of the battleground states. And the impact on the market then is volatility stays high because you never know how that's going to end. Especially how they're going to react in a scenario like this. Putin is pulling his punches or not pulling his punches at the moment with the BRICS. A lot of stuff is going on behind closed doors. Then I was speaking to a couple of guys who were long in oil, and they were rather disappointed that Israel didn't bomb the crap out of Iran. I said, do you hear yourself talking?
Absolutely.
There is no third world war looming, at least in this action. Oil is coming down, and you're disappointed. No, get your head screwed on. But that's the world we're living in at the moment, and that makes it so difficult. The market I feel most confident at the moment to actually put money in is the volatility market through the VIX, because I know how the mechanics work and how the world, at least at the moment, thinks, do I want to sell volatility to somebody else or not? Not a lot of people want to do it, right? You see that in these markets. But there is, Tuesday next week is the natural threshold. If we see a clear victory by one or the other side, volatility on the short term will collapse without any doubt, because people say, fine, whoever is there, they're going to print more money, there will be flood into the market, and that brings calmness in. But when we take the tactical spiel out of the game, the strategic point we just discussed earlier, in my mind, what I'm going to do, I'm not going to buy bonds. I'm sticking in my gold investments. What concerns me, you already hear your letter carrier talking about you should invest in gold now.
I don't know. Have you been down Frankfurt? In the Schillerstrasse, there's this place, this gold shop, and they even had a sign outside the door. I mean, I didn't even know these people existed, but I think they've been there for 10 years. That's how sort of hidden they are. They had almost a sign and a front door open. I was like, oh, I didn't even know these people were here. I've been down that street 1,000 times. And a bloody sign about it. So, they're praying to the, the kind of the emotion today about gold, and that's sort of kind of makes as a gold holder, it kind of makes me nervous. By the time everyone's figured this out, it's like, no, tactically, what's going to happen. That's why I got rid of the tactical positions. So okay, I still leave this other stuff over here, but maybe trim.
Nick, you soon have to give us an update on Elliott wave again, especially in gold, because you mentioned it earlier again, this point of recognition. Oh, gold is now hot, and that's usually the middle way. Because it almost feels to me now the last idiot out there has realized that gold is actually an asset which can, in the long term, save your ass. Huh?
In commodity, in normal stock markets, we do sort of one minute on Elliott wave. In stock markets, the sort of point of recognition, the third wave is usually the most powerful wave of all. And but in commodity markets, you find the most powerful wave is the fifth wave. So it's this sort of business of driven by fear or greed. So fear is what's driving in the commodity markets, and that's why the commodity markets normally get a much bigger sort of spike at the end.
Yeah.
So what's maybe we haven't, when I look at the gold chart, even though it sort of has gone up, I don't see that as something where the people are being driven by fear. So for me, there's still a lot more behind this thing, but for me, tactical out and strategic still there on that one. Yes, we'll do an Elliott wave thing. I look forward to that.
I put a gold chart on Monday in our internal meeting again, and I put a line in when the SWIFT was switched off after the Ukraine invasion by Russia. And I took a long chart with monthly data, and it did exactly what we expected it would do. First, you had the sell-off for a couple of months because everybody realized, oh, I can't use my treasuries anymore because they don't let me. So I have to get some money, some dollars somewhere. What I'm going to do, I sell gold. So that depressed the price. When that was over, it actually set the base for this huge rally we have at the moment.
Indeed, and all of those traditional correlations and the link with real rates and all of this stuff broke down after that. And I remember actually on the course you did in January with a few of the students at the time, people were saying, what is it that worries you most? And one of the things I said, well, when they sort of took the Russian money, that wasn't a smart thing to do, and we don't know the consequences. Well, we do now because we look back and we say, "Oh, look at that chart," and the consequences are quite major for the financial system as a whole, the one that we recognise. But the recent BRICS meeting in Russia didn't provide too much anti-dollar, pro-gold kind of output that perhaps a few of the punters had been hoping for. So maybe there is room for disappointment on gold, if you ask me.
Well, you have to do it slowly, I think, what you have in mind. You never destroy a currency overnight. It didn't happen to the pound sterling, didn't happen to the Deutschmark, didn't happen to the US dollar, yeah? Over time, they will deteriorate, and if you don't have a strong economy behind you, you're screwed. Huh? Yeah. But it's not happening overnight.
Indeed, and Putin is a fairly smart chap, so he's not going to piss on the dollar when he needs Trump to actually fix the war problem that he's got. So, they have to be a little bit more smart about this thing. And I think that's perhaps the reason why we haven't seen so much of the story of the new kind of BRICS financial system being an anti-dollar system.
Rachel Reed just increased the defense budget of the United Kingdom by 2.3 billion.
Everyone said, here.
Guess where that's going.
Yeah, indeed. They've already promised that number to Ukraine. So,
and they also,
the same day that they cut the winter allowance, they said, oh, by the way.
Well, it's even getting worse. Yeah, I was living in London, and both my kids went to a private school. Not because we are posh, but I saw the public schools in London, and sorry. If you want to get your kids an education, you pony up the money. So now they've introduced VAT on the 6% private schools that are there in the UK, because public schools should be for everybody. And I thought Excellent. So now only really rich people can send their kids to get a good education, and the middle classes who were fighting to send their kids to a good school, they will end up in this torrent of bad education all over there.
I'm glad I'm not a politician. It's really not easy for them. They've got no money. The only people, right, that can do this stuff are the Americans, because they can print, whereas the Brits and the French and the Germans and all of these guys, they have to have a budget with a sort of limited left and right. And the moment you go off piste, like perhaps was done a few prime ministers ago, your currency gets absolutely walloped. So the Americans are able to build their economy in a strong way. That's why they're such a powerful country, because they can get away with stuff. Perhaps they've reached the limit. We don't know, but up until now they've managed to get away with stuff. The Brits, they just can't do it. That's why they play around the edges and all of this stuff.
But you will be happy to know that in Germany we're making good progress in the Morgenthau plan to deindustrialize Germany at the moment. But Morgenthau in the Second World War, he wanted actually Germany to be purely an agricultural economy. We're destroying that as well. So it's going to be exciting for the future without industry and without food. But high energy prices.
Big car park. Yeah, indeed. So
but we don't have the cars anymore, Nick. Yeah, we've stopped producing them, or people are not buying them anymore.
Yeah. Okay. All right. Yeah, indeed. That's the state of affairs. And when we talk about the dollar, all right. So we come back to reality. The dollar should be going down if this currency is no longer going to be part of the reserve system that it once was. But when you look around and you say, okay, well, what shall I buy then? And you say, well, let's go and buy the euro. And you look at the European economies, the big European economies, France, Germany, you say, well, I wouldn't touch those. And then, so where are you going to go? So actually, it's not so straightforward living in a currency world going forward. And that's why sort of a larger portion of non-currency assets, even the other commodities perhaps and so on, and crypto and gold and silver and so on, might be the alternative, that you've got.
Let me end on a positive note. I'm painting you now a picture. Whoever wins the U.S. election will do the right thing. They will fight inflation by producing more stuff. And get rid of inflation that way. They will liberate the markets. They will take bureaucracy down, and the middle classes will become richer again, and we will all have a happy place.
Look forward to it. Rock on Elon Musk, because I think he can do it.
Well, he's the magic guy. I hope nobody will ever figure out that he's actually selling cars at Tesla. Because if he gets the valuation of a car company, he has been the richest man in the world for a long, long time.
Indeed.
Nick, thank you very much for your time. Thank you for watching us. If you want to see this show live, call me. I might be able to squeeze you in for the last seminar, especially if you speak German. Nick will always speak English because he claims to not speak German, which is a lie. One day we do that in German, Nick. I promise it. And if you like that, share us. The feedback I got for not having Nick on for 4 weeks was tremendous. So obviously we are...
Well done for getting rid of him.
No, not at all. Not at all. The opposite. So what's going on there? Where is he? Said easy. I'll get him on again. I'm curious what's happening in the market. Thank you very much for enlightening me, Nick. And I hope I see you all soon in the near future and we do it more regularly again. Thank you. Bye-bye.
Bye-bye.